The US dollar has made a nice little comeback in recent sessions, with the rally accelerating on the news of the resumed trade talks between the US and China. We've also seen some currency-specific negative drivers that have been helping the dollar out. In the Eurozone, there's been a wave of dovish and downbeat-leaning central bank speak from various ECB officials, while in the UK it's been about ugly manufacturing PMIs and worry over no-deal Brexit contingency plans from the Tory candidates. Over in Australia, Aussie has been contending with added downside pressure from softer PMI readings out of both Australia and China, and in Japan, discouraging components in Monday's Tankan readings had triggered some yen declines. As far as risk sentiment goes, investors have been fine to keep playing the never-ending game of pushing stocks to record highs on any good news, which for the most part has actually been less about good news per se and more about record highs on risks associated with bad news being averted. With that said, we continue to caution against expectation for any meaningful upside in stocks from current levels because of this questionable pattern, and perhaps more importantly because of the state of the global economy now seemingly a lot more vulnerable to negative shocks with government stimulus tools and central bank accommodation measures so exhausted. While the S&P 500 has indeed continued to push to record highs into the third quarter of 2019, over 10 years after the 2008 crisis began, we'd also highlight a clear level of discomfort in the run-up towards 3,000, with the major index making a record high back in January of 2018 around 2880, and since then, only managing to put in marginally higher record highs, still capped below 3,000. So yes, more record highs since January 2018, but not exactly the most convincing bullish price action. At this stage, whether or not S&P 500 3,000 is taken out or not seems to be less relevant and could end up being more of a footnote than anything else ahead of what we believe will be a major capitulation in U.S. and global equities. And while the U.S. dollar has recovered on the news of renewed trade talks between the U.S. and China, we don't believe this should be taken as a message the U.S. administration has any plans to move away from a soft U.S. dollar trade policy that it has been committed to enforcing. Looking at the calendar for Tuesday, the market will be digesting the latest RBA decision while taking in German retail sales, Eurozone producer prices, UK construction PMIs, Canada manufacturing PMIs, the New Zealand GDT auction, and Fed speak from Williams and Mester. That's all for now.